Hello, everyone. I am Trevor Heisler from MBC Capital Markets Advisors, and welcome to the D-Box Technologies Fiscal 2024 third quarter earnings presentation. At the end of this presentation, there will be a brief question and answer session. Before turning the call over to Sébastien Mailhot, President and CEO of D-Box, I would like to remind you that today's presentation will contain forward-looking statements within the meaning of the safe harbor provisions of Canadian provincial securities laws. Forward-looking statements involve risks and uncertainties, and undue reliance should not be placed on such statements. For additional information, please consult the MD&A for the quarter, the Risk Factors section of the Annual Information Form, and D-Box's other filings with Canadian securities regulators. D-Box does not undertake to update any forward-looking statements, and such statements speak only as of the date made. I would also like to point out that all dollar amounts in this presentation are in Canadian dollars unless otherwise specified. I'll now turn the presentation over to Sébastien. Please go ahead.
Thank you, Trevor, and hello, everyone. The box office in the second half of calendar 23 was hampered by month-long Hollywood strikes. The overlapping actors and writers' strikes brought film promotion to a halt and resulted in the postponement of several films. During our second quarter presentation a few months ago, I mentioned that we were expecting a softer second half to our fiscal 2024 as a result of these strikes. This was indeed the case in our third quarter, as there were no smash hit movies this past holiday season, while the prior holiday season benefited from Avatar and Black Panther sequels. As you can imagine, the strikes and resulting delays in box office releases created a fair amount of uncertainty in the industry, leading to some of our cinema partners postponing capital spending. Not surprisingly, both of our rights for use and our system sales revenue were down in the quarter as a result of this temporary issue. Importantly, this issue did not impact our business in sim racing or professional simulation and training, and we continue to manage our expenses, flexing where appropriate. Here is a look at our third quarter results. Our total revenue decreased 23% to 8.1 million, with rights for use down 29% to 1.4 million, and system sales down 21% to 6.7 million. The decrease in both right for use and system sale was mostly due to the labor disruption in Hollywood. Gross profit excluding amortization decreased to 4 million from 5 million a year ago. Our gross margin, excluding amortization, did increase from 48% to 50% as a result of our sales mix, with a lower proportion of system sales during the quarter compared to a year ago. As I mentioned earlier, we remain focused on managing our expenses, with total operating expenses decreasing 600,000 to 4 million in the quarter. Our selling and marketing expense were down 14% to 1.6 million. Administration expense decreased 8% to 1.6 million, and R&D expense were down 19% to 0.9 million. We had a net loss of 425,000 in the quarter compared to a loss of 110,000 a year earlier. Adjusted EBITDA for the quarter was 90,000, down from 491,000 a year ago. On a positive note, our year-to-date results are still way ahead of a year ago. Our total revenue for the first 9 months are 24% higher than a year ago, driven by 33% growth in system sale, with increases in theatrical, sim racing, and professional simulation and training market. Right for use revenues are on par with last year. Our gross profit, excluding amortization for the first 9 months, was up 2.3 million to 14.8 million. However, margins decreased to 50% from 53% due to the product market mix. Adjusted EBITDA more than doubled to 2.4 million, and 9 months ago in the year already exceeds fiscal 2023 full year adjusted EBITDA by 33%. Our adjusted EBITDA margin improved to 8.3% from 4.8%. For the first 9 months, we had a net profit of $473,000 versus a loss of $823,000 in the first 9 months of the prior year. That's an improvement of about $1.3 million. I'll add a few quick comments on our balance sheet as at the end of December. We had a cash position and undrawn credit facility totaling $7.6 million. Working capital increased $700,000 to $9.1 million. When we reported our Q3 results, we also announced that the Special Review Committee of our Board of Directors has concluded its formal strategic review process. The committee, which was comprised solely of independent directors, was assisted by financial and legal advisors. After thoroughly evaluating D-Box standalone strategic plan against potential alternatives, the board determined that it was no longer prudent to continue the strategic review process. The review process reached to a large number of partners, but resulted in a limited number of expressions of interest. The committee did pursue a proposal from one potential buyer, but due to factors including strategic fit and current stock market dynamic, the committee determined that the transaction was not in the best interest of the corporation and our shareholders, as it did not adequately reflect the intrinsic value of D-Box and our growth prospect. The work of the Strategic Review Committee has been completed and the committee has been dissolved, but the board will continue to consider and evaluate all actionable value-accretive opportunity with an open-minded approach. Based on D-Box's strong financial performance and outlook, management and the board agree that the best path forward is for D-Box to execute its revised strategic plan focused on accelerating profitable growth in commercial market, specifically in theatrical, sim racing, and professional simulation and training. I'll now provide a few highlights on each of these three key markets. While our cinema partners were more cautious in their spending, we did add 19 net new screens to our theatrical footprint in the third quarter. This brings our total number of active D-Box screens to 898 at the end of December. We remain focused on strengthening our leadership position in theatrical and expect to grow our screen count to 1,000 within the next 2 years. We are happy to strengthen our relationship with such a premium racing brand as NASCAR. We had the opportunity to be sponsored by Coca-Cola to deliver an activation on a NASCAR race. This is great from a brand visibility perspective, as it helps attract partners and converted some sales opportunity as well. In November, the second F1 arcade location opened in Birmingham, England. The venue featured 53 D-Box equipped full motion racing simulators featuring motion and audio-visual effects to fully immerse guests in their race. As we mentioned, our prior occasion, Kindred Concept has planned for opening a total of 30 D-Box equipped F1 arcade locations over the next few years. The next one is scheduled to open in Boston in the first part of 2024. D-Box is working with a growing number of partners, collaborators, and clients in the professional simulation and training industry. Of this, we have 5 partners who each represent over $500,000 in revenue in the first 9 months of fiscal 2024. I also wanted to highlight that we recently launched a haptic expander that facilitates using more than 5 actuators at a time. Our haptic expanders provide more degree of freedom and allow even more realistic and immersive simulation experiences. Moving on to our outlook. We continue to see significant potential for growing our worldwide installed base and industry-leading haptic ecosystem. As always, we remain focused on expanding our recurring revenue and delivering profitable growth. While our technology has application in many different sectors, we will focus our effort on theatrical, sim racing, and simulation and training. Combined, these 3 markets represent more than 90% of our revenue. In the short term, we anticipate some residual impact on our theatrical business due to delays in 2024 movie caused by the Hollywood labor strikes. And as always, we continue to monitor potential risk from geopolitical issue, inflationary pressure, and supply chain constraint. On that note, I would like to take some time to answer some of the questions submitted by our investor. I will ask Trevor Heisler from MBC Capital Market Advisors to read the question for me. Please go ahead, Trevor.
Thank you, Sébastien. Here's your first question. In your Q3 news release, you mentioned the corporation's revised strategic plan is to focus on commercial markets, in particular theatrical, racing, and vocational simulation and training. Does that mean that you're leaving the home entertainment market? Were the Motion 1 chairs and other home entertainment products not getting the response you were looking for?
Thanks for the question. So we do believe in the vision around gaming and home entertainment market. That being said, and to deliver profitable growth, we have positioned some product, but the impact is limited for the time being. So that's why we're focusing on those commercial markets.
Was there any further revenue from the Motion 1 gaming chair in the quarter?
In the first 9 months, we deliver all the order we had with Motion 1. The answer has been favorable, but the commercialization of that product is under the responsibility of Cooler Master.
Okay, and up until recently, the gaming industry was presented by D-Box as a significant potential market. The gaming chairs took years to bring to market, and in the latest release, there is no word on the gaming market. Can you share some color on D-Box's performance in this segment and what efforts we're putting into it?
Yeah, as we all know, the gaming industry is an enormous market. The Motion 1 chair is a premium product, and the pricing doesn't necessarily align with the mass market approach. We do believe that sim racing is really a subsegment of gaming, and while there are people who buy D-Box equipped racing rig for their home or their own home entertainment, we see more opportunity on the commercial side. We want profitable growth, and we want it now. The commercial market we identified represent the best opportunity for the company and the shareholders.
Our next question is, when do you expect the cinema admissions to return to normal?
That's a good question. We can say for certain, but the strike are long over, which is a good news. There are still some residual effects, as some 24 movies are delayed and a few have been postponed to 2025. But this is a temporary issue that will result in the short term. In the meantime, we have several movie lineup, and we are looking at augmenting this with alternative content, such as concerts.
When did you book the revenue for the Birmingham F1 arcade location, and when do you expect the Boston location to open? Approximately how much revenue do you get for each of these locations?
So we won't comment on what we're getting by location, but we already mentioned that the rollover of all the 30 locations was a multi-million-dollar contract. We're happy to say that the Boston location will open in the first half of calendar 24, and we're already working on the next one as well. That should come not later after this one. As we said, a total of 30 locations are planned over the years, and we're all with really 60 simulator, providing a great source of revenue for D-Box over upcoming years.
Thank you. How much of the revenue decrease in the quarter was attributable to the labor disruptions in Hollywood last year?
It was by far the largest factor. As we said, several movies were delayed. There was no clear-cut blockbuster over the holiday, and we were comping again an exceptional strong showing from Avatar: The Way of Water last year. While a temporary issue, the strike last year created a lot of uncertainty over the short term, also resulting in less spending by our cinema partner system. So the good news is temporary, and we're already in discussion to move back to that growth.
The next couple questions are related to the strategic review. If you were looking to sell the company, why weren't there any takers?
During the process, there was outreach to a large number of strategic buyers and private equity buyers. As we said, the outreach limited to a limited number of expression of interests. The review committee did pursue a proposal from one potential buyers. However, due to the lack of strategic fit and the prevailing market condition, the committee decided that the proposed transactions was not in the best interest of shareholders and did not reflect the intrinsic value of D-Box and our growth potential.
Who was the potential buyer that submitted a proposal?
We are bound by confidentiality and won't be disclosing any name. As you know, this process as well is handled through the board and the strategic committee, so I'm not the one responsible to answer that question.
And our last question, with the strategic review committee review process now concluded, how will you deliver shareholder value?
We plan on continuing to execute and we remain focused on delivering profitable growth. The reality is that there are well over 2,000 microcap stock in Canada, and most of them have no analyst coverage. For the vast majority of them, there's a disconnect between their financial performance and their share price. We invite anyone listening to take a close look at D-Box. Aside from this speed bump caused by the strike in Hollywood, we have been growing revenue and profitability. Our fiscal revenue are up 24% year to date, and in fiscal 23, we grew total annual revenue by 60%. In fiscal 23, we doubled our adjusted EBITDA from the prior year, and our fiscal 24 years to date adjusted EBITDA is 33% higher than all of last year.
Okay, Sébastien, that was the end of our questions.
Well, thank you, Trevor, and thank you everyone for following D-Box. And while we have, as we said, an hiccup in this, the long term, I think we're demonstrating a long-term trend of growing both the top line and as well improving significantly the profitability. Thank you, shareholders.